Hello, hello. So our next conversation, very, very exciting. If you know anything about crypto and Web3, you definitely know our next guest. So I would love to introduce Brady Dale from Axios, having a conversation with Caitlin Long.
Yeah. Hello, ETHDenver. Great to see you guys. Thanks for sticking around Friday afternoon. I'm Brady Dale. I write about crypto for Axios. I have a newsletter, Axios Crypto. You should all just subscribe to it right now. And welcome to Caitlin Long, founder and CEO of Custodia Bank in Wyoming.
Woohoo!
So in January 2023, the Fed, the FDIC, and the OCC, the Office of the Comptroller of the Currency, put out this statement that basically said, crypto's legal, but we feel kind of weird about it. It was a sort of ambiguous statement. And a lot of people view that as sort of the start of real trouble with banking in the industry. So Caitlin, maybe you can take it from there and tell us your perspective on that story from where you sat.
Yeah, actually, if we go back in history, there has been like a repeating wave of debankings that go back to Coinbase in 2012, I think it was, lost its Silicon Valley Bank account. And part of the reason that it broke out and some of the other payment startups at that time didn't is that Coinbase was able to get a backup bank account at Cross River through its connections with Andreessen Horowitz. So banking has unfortunately been a determining factor for who wins and who doesn't in this industry for time immemorial. You're right, though, that the Biden administration, in overreacting to FTX, the timing, again, is FTX failed in November 2022. They started working. We're in a lawsuit with the Fed, and we started to see, in fact, actually, the Fed was going to approve Custodia. We actually have the draft of the approval letter that they were going to ask us to make commitments and conditions for approval. FTX filed for bankruptcy November 11th, 2022. We have a copy of that letter November 15th, 2022. Then Michael Barr had a meeting November 22nd, 2022 to discuss our application, and the first draft of the denial letter was right after that. And then they were working through December 2022 on that joint statement with the other agencies. So it all comes back to FTX. I cringe at the concept that there's even a discussion of pardoning Sam Bankman-Fried because he harmed a lot of really good people, not just his own customers, but all of us.
And so I'll give you my version of this, and Caitlin, you can correct me, but the service that Custodia was looking to offer, right, was sort of what we call a narrow bank, a bank where people could make deposits with Custodia that it would be dollars and Bitcoin. They want to do both of them. And ETH. And ETH. They'd pay a little bit of a fee. In exchange for that fee, Custodia was not going to make any loans, which meant it was a super safe bank, and they'd offer some other services too. But this is like a really interesting concept that we don't have in the United States. We don't have narrow banks. We don't have 100% total reserve banks. What's your take on why that is not a model that we allow here?
Well, the conspiracy theorists would point out that if there were a truly safe bank, that it would threaten the unstable fractional reserve banks, which is every other bank. Here's the irony, though. The stablecoin bill that's being debated in Washington, D.C., they're going to do a markup in the Senate 3 weeks from now, and 2 weeks from now. It's that soon. That is going to create non-lending banks. So we're going to see this in the United States, and it's going to be fascinating. I think this is a big change in financial services. It's bringing open public permissionless blockchains into the regulated umbrella for the first time ever, and it's a big change in financial services. I don't know how it's going to play out, whether the stablecoin issuers are going to have to get bank charters, whether the non-banks are going to be okay. There's the whole tether question. We will have, I think, some visibility into how this will all play out in the next few months.
Let's get to the stablecoin bill, but let's hold off on that for just a second. I want to hear about, I know you've said that Custodia has lost a bunch of its own bank accounts. So, like, first of all, why does a bank need bank accounts? And then what are sort of your, tell us a little bit of the story of what happened there with you guys.
So we created Custodia to be able to provide durable banking services to this industry because of the very problem that we talked about, that we've lived through 3 different waves of debankings, and this was the worst one of the bunch. Custodia was debanked repeatedly. Why did we as a bank why did we have to worry about this? Why were we not able to solve that problem for our customers? It's because the Fed denied us access to what's called a master account. The developers would understand that as root access to the core of the US financial system. And I wanted to be able to get that for this industry. The original concept of the Wyoming Special Purpose Depository Institution charter was that it would be a mutual. It would be owned by the members of the bank. And the Wyoming legislature didn't like that idea, so they wanted it to be a for-profit corporation. But that was the ethos, is we wanted to be able to create something that the industry would own and that we would be able to control whether we got debanked or not, and so we wouldn't have to go through these waves of debanking, which, of course, unfortunately hit a lot of startups very hard.
So there's a narrative out there that with a new administration in the White House, things have really changed. We saw the SEC, for example, has stood down on a bunch of the cases that it brought against different aspects of the industry. What has changed from your perspective for people regulated in the banking industry, however, since Trump took over?
Actually, nothing.
Okay.
The perception is that there has been a loosening, but none of the federal banking agencies have actually overturned any of the anti-crypto guidance. It is still presumed unsafe and unsound for a bank to touch a digital asset even in a de minimis amount, so like paying gas fees for customers in custody. We can't do that. Banks are prohibited from issuing stablecoins on public permissionless blockchains. Obviously, JP Morgan has had its Onyx private fork of Ethereum out there for years, and they have a closed network. So it's funny because Signet and Sen were closed networks, but those served the crypto industry, so they got shot. And JP Morgan has its closed network that serves the non-crypto industry, and that's fine in the regulator's eyes. I digress.
Just so folks understand what we're talking about here, I don't know if you guys remember, but like during the prior crypto boom, like around 2021, 2022, we saw a decent number of banks come out with statements like, we're thinking about doing roughly what PayPal and Venmo do. We'll let our folks, buy some Bitcoin and hold it in their bank accounts if you want. A lot of banks announced that kind of thing. Then we didn't really ever see those services go live. And that's because I think we've come to understand they had to tell the FDIC usually that was their idea. And then, what would happen after? You could describe sort of what would happen after that, Caitlin.
Well, the FDIC has been very anti-innovation. The guy who led it for almost 15 years, almost uninterrupted. There was an interim chairman during Trump's term who was not anti-innovation, but this guy, his name is Marty Grunberg, really just was anti-technology, this is why the banking system is so backwards in this country, because for the last 15 years, we've had somebody who just isn't interested in any change and would, I think, candidly, he wants us all to be, he wanted a CBDC, wants us all to be banking at the post office in paper form, okay? So the whole concept of what we stand for in our industry just blew his mind. And they were just rejecting technology proposals right and left, not just from our industry, but also from the fintech industry broadly. And any bank that tried to get involved with it, I mean, there's virtually 100% of the banks that touched the crypto industry that got consent orders, with the glaring exceptions of the very largest banks who got to skate. And the same thing happened in the fintech industry. So it's just very anti-innovation. That is going to change, no doubt, but Trump hasn't proposed yet. There are new acting heads of these federal banking agencies at the OCC and the FDIC, not yet at the Fed, but we don't have an actual nominee for the new FDIC chair yet. So it's going to take some time. And like I said in the beginning, all those anti-crypto statements are still out there. The SEC obviously has done a massive 180, but it hasn't happened yet in the banking industry.
The one thing we've seen in the banking side on the FDIC is, and this is interesting if folks want to go take a look at this, the FDIC released just several hundred pages worth of letters that they had sent, that had been sent under the previous administration about these sorts of issues. And it shed a lot of light on sort of like how this regulatory process works. Like Caitlin said, no rules have changed, but we did get a lot more visibility. That was one thing we got to see, yeah.
Yes, and it's not just the FDIC. We were talking as we were preparing about what Senator Lummis disclosed from the Fed.
Oh, yeah.
That they were taking into account controversial activities and controversial comments in assessing whether a bank could access or continue to access the root access to the financial system called a master account. And that had not been publicly disclosed before. So it's a de facto admission that this was kind of finger in the air. If we like you, you get in. If we don't like you, you don't. And of course, that's what Custodia has sued over. But the whole concept of controversial, what does that mean? Mm-hmm. There is no standard. This was never publicly disclosed. It's like the 15% limit that Nick Carter has been talking about that was imposed on banks, that banks couldn't have more than 15% of their US dollar deposits coming from the crypto industry after Silvergate. That was never publicly disclosed. This is the kind of regulatory abuse that has been rampant in Washington, D.C., where they just change the rules willy-nilly and start applying them without announcing them.
So I know that to shift towards looking forward now, I know that the topic that you're most interested in is the stablecoin legislation that's been proposed. We've got a bill that's been introduced in the Senate by Senator Haggerty. There's a bill that's being in draft form in the House, the stable bill, led by Stile and French Hill. And what's your take on these proposals? What do you feel good about? What do you feel less good about?
Definitely going to happen. So this is great. So TradFi and our industry are going to be merging. No question about it. What we don't know is, are the banks going to dominate? They're really powerful, and they give a lot of money to politicians, and they are trying very hard to keep all of us sidelined. And then the incumbent stablecoin issuers are having a scrum with the tether question, right? So it's kind of like the
Circle and Paxos is kind of who you're talking about mainly, yeah.
Yeah, it's there's a lot. Let's put it this way: this is out there on Twitter, so I'm not going to break any news here, but there's a lot of regulatory capture attempts happening. A lot of industry money got spent by the banking industry and by the crypto industry, and certain people want to see certain things and have the regulatory regime advantage themselves. And it's going to be fascinating to see, because I don't know who's going to win. We got a lot of money, lobbying money that got paid into pro-crypto politicians, and the banks are really, they believe that this is their territory, that we are encroaching upon their territory. We should go away and they should dominate it all, and they might win.
So Caitlin, obviously you have a dog in this fight and you're biased, but I'm just curious, if you were, what do you think is the right level of consumer protection? Like what's the stablecoin bill that you would write if you were a senator?
Yeah, well, it's really what the Wyoming legislation wrote, which is that we learned this in the Silvergate situation, that a bank run can happen super fast, especially with this industry where everybody's driven by technology, and that you can literally withdraw all your deposits on your online banking within a few minutes, right? So you cannot have any rolling of the dice in the investment portfolio of the bank. So the best consumer protection, Brady, is make the bank hold on to cash, so that if you want to withdraw your cash, you want to redeem your stablecoin, you can redeem it for dollars almost instantly. Really simple. Don't let the bank do what normal banks do, which is take your money, your demand deposit that you think you can get back today, and go make long-term mortgage loans or car loans or student loans with it. And the average bank in the United States right now holds 8 cents in cash against every dollar of demand deposits. The big banks hold more. They hold 12 cents in cash against every dollar of demand deposits. That's fundamentally unstable and fundamentally susceptible to a bank run. And in the crypto industry, I think we've learned that business model does not work. You can't marry a traditional fractional reserve bank with liabilities from our industry that can move at literally at the speed of light. And so the right thing to do from a consumer protection standpoint is just the stablecoin issuer be honest and hold cash to back the stablecoin liability. Really simple.
And like, what else if so we were talking beforehand, you were saying you think basically, even though, like, for example, in the Haggerty bill, it says you can be a private stablecoin issuer, you don't have to be a bank, you'll be under the OCC, but you think that it'll amount to the same thing, it'll sort of amount to the equivalent of a bank charter. So like, if you have a bank charter, what more layers does that add to your work?
Good question. Well, the law says that every eligible depository institution does get a Fed master account. That's the litigation that's in process right now. And we don't know how that's going to come out, but it may set a precedent. The Fed literally told a judge in a related case that its motivation doesn't matter. In other words, it's arguing that it can do anything it wants and not have its decisions be judicially reviewable. So let's see if that stands. That's their position. But they're supposed to be giving the statute says that every eligible depository institution automatically gets a master account. So ultimately, that's the big difference between a bank and a non-bank is getting root access. Again, developers would really understand this because it's not just root access to FedWire, it's also root access to the core of the system so that you can much more quickly without going through an intermediary with delays and cost and counterparty credit risk, you can settle your transactions a lot faster. And then there's another esoteric piece which has to do with bankruptcies. Banks have better protections for consumers than non-banks in bankruptcy. And unfortunately, a lot of people have learned that lesson the hard way in the Celsius bankruptcy and more recently the Prime Trust bankruptcy. Trust companies are not treated as, customers of trust companies are not treated as well as customers of banks if the financial institution goes down. And so I think it's going to be interesting to see how the market evolves. There's a lot of benefits to being a bank in financial services, and the same thing's true in the custody business. The securities custodians are almost entirely banks, not trust companies. There's a reason for that, and I think that the stablecoin market might evolve in that direction as well. That's not to say that all of us are going to be frozen out. It is to say that all of us will probably, as that market shakes out, end up getting the bank charters for those reasons because they are better for consumers.
And we only have 1 minute left, but really quickly, do you think this next round of stablecoin legislation should deal with decentralized stablecoins, or should it just leave it alone for now?
Well, it's not trying to. It's just dealing with the centralized ones. So the algorithmic stablecoins, it's literally leaving alone. But
is that the right call?
Well, look, I mean, the DeFi is a different animal, truly. And the SEC obviously made a huge statement yesterday about meme coins. And Jonathan Mohan and I were just talking about the sufficiently decentralized, giving you actually, if your project becomes sufficiently decentralized, in many ways that's better from a liability perspective than having a corporate form where the reason why many people form corporations is liability protection. If you are a sufficiently decentralized project, then you have that same kind of liability protection. So DeFi, I think, is handling it in a very different way, which is why they're leaving algorithmic stablecoins out of the stablecoin bill.
All right, well, great. Well, thank you, Caitlin. If you guys want to follow all these issues, subscribe to Axios Crypto. Thanks for being here. Thank you.
Thank you.